Sooner or later, every investor encounters a stock market crash, a sudden and often unexpected drop in market value. While such events can be unsettling, they're a natural part of investing. The key is to prepare in advance by building a resilient portfolio. In this lesson, we'll explore some smart investment strategies and choices you can consider today to help safeguard your portfolio during extreme market conditions. By the end, you'll have actionable insights to strengthen your financial foundation and weather market volatility with confidence. Let's dive in. Understanding Treasury bonds, a teaching. What are Treasury bonds? Treasury bonds, or T-bonds, are some of the safest investment options available because they are backed by the full faith and credit of the U.S. government. This means the government guarantees to repay the bondholder the principal and interest, making these bonds an attractive choice for low-risk investors. Think of Treasury bonds as a loan you give to the U.S. government. In return, the government agrees to pay you regular interest until a specified date when they will pay back the full amount you initially invested, the face value. How do Treasury bonds work? Term length. Treasury bonds have long terms of 20 or 30 years. Interest payments. You'll receive interest payments every 6 months until the bond matures. Return on investment. Once the bond matures, the government will return the bond's full face value. For example, if you buy a $10,000 Treasury bond with a 5% interest rate, you'll receive $250 every 6 months as interest, 5% annual rate divided into 2 payments. After 20 or 30 years, you'll also get back your $10,000. Why do investors like Treasury bonds? Low risk. They are among the safest investments because of the government guarantee. Steady income. You get predictable interest payments over time. Good yields. Sometimes. In favorable economic conditions, Treasury bonds can provide decent returns compared to leaving your money in a savings account. When are Treasury bonds less favorable? While Treasury bonds offer safety, their returns don't always keep up with inflation. Inflation reduces the purchasing power of your returns, which can make bonds less appealing in high inflation periods. For instance, if inflation is 6%, but your bond pays a 5% return, you're effectively losing purchasing power. In such situations, other government-backed investments may be better options. I-bonds. These are adjusted for inflation, so their returns increase when inflation rises. TIPS, Treasury inflation-protected securities. Similar to I-bonds, TIPS are designed to keep pace with inflation. How can you buy Treasury bonds? You can buy Treasury bonds, along with I-bonds and TIPS, directly from the U.S. government's official platform, treasurydirect.gov/www.treasurydirect.gov. The site makes it easy to purchase, manage, and redeem these securities without needing a middleman. Key takeaways. Treasury bonds are reliable, long-term investments that provide steady returns. They are best suited for investors seeking safety and predictable income. In times of high inflation, alternatives like I-bonds or TIPS may offer better protection for your money. Now that you know the basics, consider how Treasury bonds fit into your overall investment strategy. Understanding corporate bond funds, a teaching guide. Corporate bond funds offer an appealing middle ground between government bonds and more volatile investments like stocks. Let's break this down step by step. What are corporate bonds? Think of corporate bonds as loans you give to private companies. In return, the companies promise to pay you back with interest. This works similarly to Treasury bonds, where you lend money to the government. The key difference? With corporate bonds, you're lending to businesses rather than Uncle Sam. Why invest in corporate bonds? Corporate bonds generally offer higher returns than government bonds because companies are a slightly riskier bet than the government. However, they still provide the security of fixed income, making them a relatively stable investment. How do corporate bond funds work? Investing directly in individual corporate bonds can be tricky for everyday investors. Instead, mutual funds and exchange-traded funds, ETFs, pool money from many investors and buy a diverse mix of corporate bonds. You can purchase shares in these funds through most brokerage accounts, gaining exposure to hundreds of bonds at once. What can you expect in returns? High-quality corporate bonds, those issued by financially strong companies, have historically delivered steady and reliable returns. For example, the SPDR Portfolio Corporate Bond ETF, SPBO, which tracks a broad index of U.S. corporate bonds, provided a 3-year trailing return of around 8%, even weathering challenges like the COVID-19 pandemic. Over longer periods, 5 to 10 years, returns average closer to 4%, which is lower but still stable. Caution. These returns lag behind those of stock market funds like the SPDR S&P 500 ETF Trust, which has delivered trailing returns of at least 14% over the same time periods. Who should invest? Corporate bond funds are a good option for conservative investors looking for moderate risk and steady income, those wanting more yield than government bonds but less volatility than stocks. However, if your primary goal is maximizing long-term growth, equity funds like the S&P 500 might be a better choice. Key takeaways. Corporate bond funds offer diversification and steady income. 2. They are safer than stocks, but riskier than government bonds. 3. Returns may be lower than stock market funds, but are often consistent. 4. Mutual funds and ETFs make it easy to invest in corporate bonds without needing to select individual bonds. By understanding your risk tolerance and investment goals, you can decide if corporate bond funds align with your financial plan. Teaching about money market mutual funds. What are money market mutual funds? Money market mutual funds are a type of investment that focuses on ultra-low-risk securities with short maturity periods, typically less than a year. These funds prioritize safety and liquidity, making them one of the safest investments available outside of government bonds. Think of them as a way to park your money temporarily while earning a bit of interest, without exposing yourself to significant risk. Why are they considered low risk? Short-term securities. These funds invest in things like Treasury bills, certificates of deposit, and high-quality corporate debt, which have very short timeframes for repayment. Highly regulated. They are subject to strict regulations that ensure safety for investors. However, the trade-off for this stability is a low return on investment. Current returns of money market funds. In today's financial environment, money market funds offer very small returns. For example, many of these funds provide returns as low as 0.01%. This makes them less attractive as a long-term investment. If you're looking for significant growth, money market funds might not be the best fit. When should you use money market funds? Money market mutual funds can be useful for 1. Parking idle cash, when you're unsure where to invest next or want to maintain liquidity. 2. Emergency reserves. They allow quick access to funds without much risk. 3. Short-term goals, like saving for a purchase you plan to make in a few months. Alternative. High-yield savings accounts. If you're not tied to using a brokerage account, consider a high-yield savings account. These accounts often offer higher returns compared to money market funds. FDIC insurance, up to $250,000, providing additional safety. Easy access to your money. Key takeaway. Money market mutual funds are ideal for short-term savings and liquidity, but they don't offer substantial growth. If safety and accessibility are your priorities, they can work well. However, for better returns on your cash, explore options like high-yield savings accounts or certificates of deposit. Would you like to dive deeper into specific examples or explore alternative investments? Understanding gold bullion as an investment. Why gold? Gold has long been a preferred choice for investors, especially during periods of market uncertainty. Its value often rises when the broader market faces challenges. For example, during the Great Recession, 2008 to 2011, gold prices more than doubled, demonstrating its appeal as a safe haven asset. The risk of over-reliance. While gold can be a stabilizing factor in a volatile market, it's important not to overdo it. After market downturns, when growth resumes, investors tend to shift back to higher-risk assets. As a result, gold's value may stagnate or even decline during economic recoveries. The long-term perspective. Gold's historical performance is impressive. Its price has risen about 9,000% over the last century. However, it pales in comparison to the stock market. For instance, the Dow Jones Industrial Average, DJIA, has seen gains exceeding 60,000% in the same period. This highlights the potential trade-offs between gold and other investment types. Practical considerations. If you decide to invest in physical gold bullion, be prepared for additional costs. Storage. You'll need a secure place, such as a safe deposit box or specialized vault. Insurance. Protecting your investment comes with ongoing insurance expenses. Key takeaway. Gold can be an effective part of a diversified investment strategy, particularly during uncertain times. However, it's crucial to balance your portfolio and not rely solely on gold for long-term growth. Diversification across asset classes often yields the best results. Understanding precious metal funds, a teaching approach. Investing in precious metals can be a great way to diversify your portfolio, but managing physical gold, silver, or platinum comes with its own challenges. These include storage and insurance costs, which can be inconvenient and expensive. That's why many investors choose precious metal mutual funds and ETFs instead. Why choose precious metal funds? Precious metal funds allow you to gain exposure to gold, silver, platinum, or other metals without dealing with the physical items. They are often more accessible and easier to manage. However, before investing, it's important to understand that these funds come in two main types. 1. Price tracking funds. These funds directly track the price of the precious metal itself. For example, if gold prices rise, the fund's value typically increases as well. 2. Mining and refining company funds. These funds invest in companies that mine, refine, or process precious metals. While their performance is often linked to metal prices, other factors like company management and market conditions can cause greater fluctuations in value than the metal's price alone. Hash pros and cons of precious metal funds. Like any investment, precious metal funds have advantages and disadvantages. Advantages: provide stability during economic uncertainty, a common feature of precious metals as a safe haven asset. Avoid the hassle of physically holding and insuring metals. Disadvantages: precious metals often underperform in bull markets when stocks are thriving. Returns may not match broader market growth. A closer look at performance. Let's consider a real example. The iShares Gold Trust Fund had a 5-year trailing return of 6.50%. Compare that to the SPDR S&P 500 ETF, SPY, which had a 5-year trailing return of 17.51%. This shows that while precious metal funds can be stable, they may not generate the same level of growth as a stock-based fund during bullish periods. Key takeaway for investors. Precious metal funds can be a smart choice for diversification or as a hedge against economic downturns. However, they shouldn't form a large portion of your portfolio. Do your due diligence. Understand the type of fund you're investing in, price tracking versus mining companies. Assess your risk tolerance and long-term financial goals. By balancing precious metal funds with other investments, you can create a well-rounded portfolio tailored to your needs. Understanding real estate investment trusts, REITs. Investing in real estate doesn't always mean buying properties yourself. If you're interested in real estate but want an investment that's more flexible and easier to manage, real estate investment trusts, REITs, might be a great option. What are REITs? Definition: REITs are companies that own, operate, or finance income-generating real estate. These can include office buildings, shopping centers, apartments, hotels, and more. Purpose: by pooling money from many investors, REITs allow you to invest in real estate without the need to buy, manage, or maintain property yourself. Why consider REITs? 1. Liquidity. Unlike directly owning property, you can easily buy and sell REIT shares on the stock market, making it a more liquid investment. 2. Diversification. REITs often perform differently from stocks or bonds, reducing the overall risk in your portfolio. 3. Income potential. Most REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends. This makes them an attractive option for investors seeking regular income. The benefits of REITs: hedge against stock market crashes. Since REITs are tied to the real estate market rather than the stock market, their performance may not directly follow stock market trends. High dividends. REITs often pay higher dividends compared to traditional stocks, which can be appealing for income-focused investors. The risks of REITs. Industry dependence. REIT performance can be affected by the specific real estate sectors they're involved in. For example, a retail-focused REIT might suffer during economic downturns when consumers spend less. Market volatility. While less correlated with stocks, REITs are not immune to market fluctuations, especially during broader economic challenges. Key takeaways for investors. REITs can be a useful tool for diversifying your portfolio and gaining exposure to the real estate market without owning property directly. They provide the potential for steady income through dividends, but come with risks tied to the real estate industry and economic cycles. By understanding the benefits and risks of REITs, you can decide whether they fit into your overall investment strategy. Would you like to explore specific types of REITs or strategies to evaluate them? Understanding essential sector stocks and funds. When the economy slows or faces a recession, certain sectors tend to be more resilient. Why? Because they meet essential needs, goods and services people continue to rely on, no matter the economic climate. These include consumer staples, healthcare, and utilities. Investing in stocks and funds from these sectors can help cushion your portfolio during market downturns. Why consider essential sector investments? Even in tough economic times, consumer staples, e.g., food and household items, are still purchased. Healthcare services remain crucial as people continue seeking medical care. Utilities like electricity and water are indispensable. This resilience means essential sector stocks and funds may experience less volatility compared to other sectors, making them an attractive option for risk-conscious investors. ETFs in essential sectors. If you're interested in these stable sectors, but still want the benefits of equities, stocks, exchange-traded funds, ETFs, offer a diversified way to invest. Below are 3 ETF options to consider. 1. Healthcare Select Sector SPDR Fund, XLV. What it does, tracks the healthcare companies within the S&P 500. Why invest? Healthcare remains a necessity regardless of economic conditions. Top holdings: Johnson & Johnson, J&J, United Health Group, UNH, Pfizer, Thermo Fisher Scientific, TMO. 2. First Trust NASDAQ Food and Beverage ETF G. What it does, tracks the NASDAQ U.S. Smart Food and Beverage Index, which includes key food and beverage producers. Why invest? People will always need food and drink, making this sector a reliable choice. Top holdings: Bunge, Tyson Foods, TSN, The Hershey Company, HSY, General Mills, GS. Top 3. Vanguard Utilities ETF. What it does, tracks an index of utility stocks, providing exposure to electricity, gas, and water providers. Why invest? Utility companies generate steady revenue, even during economic downturns. They also tend to pay higher than average dividends. Top holdings: Duke Energy, Exelon Corporation, EXC, American Waterworks, Next Era Energy. Key takeaways for investors. 1. Diversification. Essential sector funds can help balance your portfolio, providing stability when other sectors falter. 2. Reduced risk. While still equities, these sectors are less prone to severe declines in a recession. 3. Dividends. Many utility stocks, like those in VPU, pay consistent dividends, offering income potential alongside long-term growth. By incorporating ETFs like XLV, FTXG, or VPU into your portfolio, you can build a more resilient investment strategy to weather various market conditions. Understanding total market index funds and investing during market downturns. Investing in the stock market can feel daunting, especially during a market crash. However, learning to navigate these tough times is key to long-term financial success. Let's break it down step by step. What are total market index funds? A total market index fund is a type of investment fund designed to track the performance of the entire U.S. stock market. Instead of picking individual stocks, you own small pieces of thousands of companies, spreading your risk across a broad portfolio. This diversification helps reduce the impact of poor performance by any single stock. Why keep investing during a market crash? When the stock market is down, it might feel counterintuitive to invest more, but there's a strategy that explains why this approach works. Dollar cost averaging. What is dollar cost averaging? It's the practice of investing a fixed amount of money at regular intervals, regardless of market conditions. Why does it help during a market crash? When prices drop, your fixed investment buys more shares. This lowers your average cost per share over time. Once the market recovers, those lower cost shares could lead to higher gains. For example, you invest $100 every month. When the price is $50 per share, you buy 2 shares. When the price drops to $25 per share, you buy 4 shares. Over time, you accumulate shares at a mix of prices, potentially improving your returns when the market rebounds. The key to success? Patience. While continuing to invest during a downturn can position you for growth, remember that recovery takes time. Markets don't bounce back overnight. It could take months or even years, so patience and consistency are essential. Ready to get started? To take advantage of dollar cost averaging and invest in the entire U.S. stock market, consider total market index funds. These funds simplify investing by giving you exposure to a wide variety of stocks. Here's a quick task. Research reputable total market index funds. Some well-known examples include Vanguard Total Stock Market Index Fund, VTSAX, or Fidelity Total Market Index Fund, FSKAX. By focusing on consistent investing and staying the course, you're setting yourself up for potential long-term growth, even during challenging market conditions.